All right, yes, perfect. So in the previous video, we touched on the execution phase errors. That was number 5 and number 6 of the foundational levels. That is where the most emotions are starting to rise. Now, after we have a lot of emotions accumulated over a long period of time, of course, we also need to know when to take a step back. So in the previous video, we touched briefly on the psychology meter. That is what we touched on at the end of the video. That is exactly what we are going to talk about today. Like I mentioned, when we trade and there's a lot of emotions starting to rise over a long period of time, those emotions need to go somewhere. They need to go somewhere. And if we only trade, don't do anything else, then all those emotions will be targeted towards eventually revenge trading, overtrading, forcing something. So we need to take into account the psychology meter. So what you're seeing here on your screen is a beautifully drawn psychology meter by me. No, but this is a psychology meter and it helps us to visualize what we are going to talk about today. So on the right side of the psychology meter, we have a high risk of error. On the left side, right there, that is of course a low risk of error. So that is the state where we want to be. And slowly with more trading, we'll get more to the right there. And we want to be all the way back at the beginning. The way I always like to see this and the way I like to compare this is to the gym. If you've ever lifted weights in your life or you've done it, again, it doesn't have to be lifting weights, but anything that requires a certain skill or you to get stronger, to learn something, etc. Then in the gym, usually if you go for a very long time and then eventually you feel like you're not making any progress, you're hitting a flat line, you're not making any progress anymore. When you take a week off or so and you think you're not making any progress in that week that you are taking off, then when you come back, all of a sudden, the flat line you had, the weights that you were struggling with, all of a sudden become a little bit easier. And you're like, what happened? That is the power of rest, the power of just simply taking a break. Taking breaks in trading is as well an extremely underrated thing. People don't talk about breaks in general, in business, in whatever it is. People don't talk about breaks. They always tell you, go, 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 go. That hustle mindset, that the grinding mindset. And although I do have that mindset as well, where I keep going, 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 but I understand that there's time to go and there's time for breaks. Where if I am not doing anything and I'm not trading, I want to fully dedicate my time to actually taking a break. So not any distractions, not still having notifications on my phone on what's happening in the trading world. No, zero, just fully focusing on my rest, fully resetting. Now, why is this important? Because when we trade over time, the more we trade, the less we take breaks. So if we don't take any breaks, when we execute constantly with new trades, etc., then we will stack up emotions. Those emotions need to go somewhere. They can't just be stuck in us all the time. Those emotions eventually will be targeted to something. We need to make sure they are targeted to our rest, as in we get those emotions out while we are actually resting, whilst we're doing nothing, and we can control those emotions again. But if we don't do that and we don't take those breaks, then what will happen? We will have those emotions that start stacking up, and eventually we will target those emotions to our revenge trading, to our overtrading, to, for example, forcing IDs, not having that clear state of mind again. So first of all, I want to again tell you a story on why we are doing this, why this is extremely beneficial. It leads me back to the basics, understanding the basics. What is the basics of the market again? Well, in order for someone to buy, there also needs to be a seller. In order for someone to sell, there also needs to be a buyer. So if we want to buy something, there needs to be a seller at that exact level. We know, again, that trading 99%, 95% doesn't make money. All right, perfect. How can we be a part of that 5% that does make money right there? Well, the technical analysis overall is already out there. There's a lot of different methods on how we can actually approach our technical analysis, etc. And I think to an extent, they all work. Some might work better than the others. Some are just not that great. Some are great. It just depends on what do you actually want to learn right there. What makes sense to you? What are you comfortable with? All right, so So the technical analysis, again, every single person in the world can make sense of the technical analysis. As in, that's not the problem. You have the best technical analysis traders that are not even profitable. Why not? Because they can't cope. They can't understand their psychology. So actual liquidity in the market, the seller that we need when we want to buy, is not someone that we are taking out on a technical analysis perspective. It's not someone that on technical analysis level we are better than. No, it's someone that couldn't keep their psychology in check. Think of how many people are trading without a stop loss, are forcing a trade right now, are not sticking to their trading plan, are now revenge trading, are now over trading. That makes up the majority of the market participants. The people that can't keep their psychology in check, the people that are making psychology errors. So that is our liquidity. So we also understand that, all right, in order for us to actually become the best at what we do, yes, the strategy overall, we need to have those guidelines, because without those guidelines, again, the psychology doesn't make sense. So we can't blame everything on psychology. But if we can't make our psychology work, then the technicals will never work. So that is very important. And the reason that is very important is, again, what we're going to touch on right now. So what is the cause of this psychology meter moving to the right, where we get closer to a higher risk of actually making an error right there? Well, the first thing that we have is price not agreeing. In other words, you might be trading in low probability conditions. That is the first cause on a psychological level where you now will be affected and you have a high risk of error. Why is this? Well, this is simply because, again, when we try to trade those low probability conditions, it's very tough. It takes a lot of brain points, takes a lot of energy, takes a lot of ego. There's ego involved in everything that we do. And again, whether we want to admit it or not, if I make a forecast and the forecast is not right, definitely bet there is some ego in me that was like, oh, I was wrong. Damn, I was wrong. Why was I wrong? And that is normal. That's absolutely normal. It's human nature. You always want to be right. In trading, it's accepting that we can also be quote unquote wrong. We're not wrong. You don't have to see it as wrong. We're just trading probabilities. All we are doing is we are looking at the market through a lens of probabilities. So we know there's a high probability of this happening over that happening. Perfect. Well, we need to find a market. We need to find an instrument. We need to find a trade ID that is high probability. A high probability of actually playing out. If we don't do that, then we already are stressed about, is this actually high probability? Is this not low probability? I'm not sure about this. I'm not sure about that. That will already increase the risk of error. So where we start with a fresh mind, if we are now trading low probability conditions, we will go a little bit higher, where we are now increasing our risk of error. Again, the price not agreeing and trading in low probability conditions already speaks for itself, right? It already speaks for itself where, of course, you would not do that. But understanding the actual why right now on a psychological level is also very important, and it might actually prevent you from next time when you are trying to trade a low probability condition. Remember, you are increasing your risk of error. And the thing here is as well, what I want to mention is that first, when we're just starting out, first we have to find high probability price action, and we also have to pay our attention to our psychology, which in the beginning, if you're just starting out, is quite difficult, right? Because you have to pay attention to the high probability conditions, which is already quite difficult to find sometimes, especially if you're just starting out. Then you also have to pay attention to your psychology right now. So just starting out, I just want you to know that if you're just starting out, you're a beginner, and this is your first enrollment, for example, this is the most difficult phase. You are in the most difficult phase. From here on, it can only get easier. It can only get easier. So if we stick to it and we stick with it, it can only get easier. You are right now in the most difficult phase of your trading career. It can only get easier. So why is that again? Well, after getting more experience, you will notice You just have to focus on your psychology and focusing on the psychology meter, which is again what we're also going to go over. But after a while, those high probability conditions will be routine. It will be easy to spot. So all you would have to do then is focus on your psychology. Am I keeping my psychology in check? So that is very important. I need you to know that as well. So again, the first step is price is not agreeing. That can allow us to have that higher risk of error. Perfect. Then the next thing is time is not agreeing. With time, again, I'm aiming at the month that we are trading in. For example, the month that we are currently in, December. Then also the news. So if we are trading on a day where we don't have news supporting the ID, and in the kill zones. The specific kill zones criteria aren't met, for example, and we are trading, then those things are all what can eventually lead to a high risk of error. Why is that again? Because those things can lead to low probability price action. So understanding when time is not agreeing is when we just, what we talked about in the trading plan again, in the execution and the analyst phase, when time is not agreeing, we simply just need to stay out of the market. But understanding if we don't do that, what is the consequence of that? There's a higher risk of error. Because if we now get that low probability condition, low probability price action, where price is now consolidating instead of actually moving towards our take profit, etc., then we get caught up in that. Getting caught up in a consolidation where you expected or you were looking at a trade ID, you were looking to create some form of trend expansion to hit your take profit, of course. So when that doesn't happen, you get caught up in a consolidation. You are going to think about the whole day, basically. Because all we're doing right there is just constantly checking, are we still in a consolidation? Are we expanding right now? That takes a lot of brain points, a lot of energy away from us, and a lot of focus. Which means that overall, what will happen? The psychology meter moves to the right, and we will increase the risk of error right there. So that is also very important. And over time, again, these things start to stack up. So time, make sure, is always agreeing. That makes the environment a little bit easier to actually stick to our psychology. Very important. So then the next thing is, and that's the third one, is chart time. Our overall chart time. How much time are we spending on the charts? If we are, again, spending 8 hours a day on the charts, that is way, way, way too much. And 8 hours of actually trying to find a trade ID, etc., that is way too much. Again, that leads me back, and that's just the foundation. That's the values that we have. So we have certain values that we go over, and everything is attuned to those values. So in the philosophy video, in the intro video, we go over certain values. A value here, what we talked about, is understanding again that we are out competing someone on a psychological level. So our psychology should be stronger, our mindset should be stronger than someone else. We should be able to keep our psychology in check longer. Who do you think is the person that can keep their psychology in check the longest? Is that the person who spends 8 hours a day trying to find a trade ID, or is that the person that already knows when and where to get involved, so can use alerts, for example, and can now limit their chart time? Limiting that chart time, of course, leads to a lower risk of error. Having a lot of chart time, a lot of emotions involved, a lot of overthinking will, of course, lead to a higher risk of error right there. So that is very important to understand, that the next thing, the next cause of that higher risk of error is chart time. We always want to have the least amount of chart time possible, of course. Then the next one is, and that's the fourth one and the last one as well. These are, again, the bigger overview. So in between, in small details, we might have things that increase the higher risk of error as well. But the fourth one is a loss, a win, or a break even. What do I mean by that? I mean, just in general, a single trade ID that plays out, whatever the trade ID might be, if it's unprofitable, if it's profitable, if it's break even, so a loss, a win, or a break even, it doesn't matter. Whatever the trade ID outcome is right there, it will increase the risk of error. Let's say we take a win. And again, what was one of the 5 emotional errors that we can encounter? That's confidence, right? So one of them is confidence. So if we take a win now, what might happen? Well, our confidence might be sky high. Confidence being sky high is not necessarily a good thing. That is not confidence. Confidence is that very calm behavior where if we have that sky high confidence, that's not a good thing, because now we will think every trade idea that we choose will play out because we are so confident, we think we are the best. That's not a good thing again. And that might lead you to now taking trade ideas that you wouldn't take with a fresh state of mind. So your risk of error has increased. Where as well, after a loss, of course, your risk of error also increases. You are not the same person that you were before you take a trade. You are simply not the same person. Your psychology is affected. Whether you notice it or not, your psychology is affected. Your risk of error is increased after taking a trade right there. That's extremely important to understand. Now, someone else's risk of error might be a little bit higher. Someone else's risk of error might be a little bit lower. That depends on the experience overall that you have as well. But again, as a beginner, as just starting out, I would argue your risk of error after a loss, a win, or a break even is extremely high. The urge to rush back into the market, for example, the urge to do something that you shouldn't do, that is very important to understand. So again, well, now we've talked about these risks of errors, but what we've just talked about is the first part, as in we now know that basically with everything that we are going to do, even if we get to a win, a loss, or break even, in general speaking, just trading, that means that we are going to increase our risk of error. All right, well, then we also need to know how can we decrease that again. That is where it's now very important to also have a strategy on how we go about our psychology meter, which I will tell you the basic guidelines on how I approach, again, my psychology meter. So these, again, are all the factors that increase the risk of error. And the way I see it right now, or the way I see it in my personal trading, is the only thing I'm doing is I'm constantly monitoring if I can take a rest. If I can take a rest where someone else is trying to push their luck. So basically saying, I run when it actually matters. I get involved when it actually matters. I increase the risk of error when it actually matters. So when time is there to allow it to happen. So what do I mean by that again? Well, if I take a rest where someone else is trying to push their luck, I mean, for example, a person that is trying to trade when price is not agreeing, I take a rest. When time is not agreeing and another person is trying to trade, I take a rest. Where I have low chart time and someone else is having a lot of chart time, I take more rest. When I take a loss, a win, or a break even, I know that after that, my risk of error has increased, so I take a rest. So for example, when time is not agreeing and we have December, currently I have not been super active in trading December. Well, why is that? Well, think about it. Who is going to be better in the next year, in 2024, when we go into the potential high probability conditions again? Is that going to be the person that took December off, not completely off, as in I'm still focusing on my trading to still be in sync with the market, so I still know where it's want to go, etc. But my emotions are not necessarily involved that much. Where another person that's trying to trade December constantly, every single day trying to trade December, which is then potentially trading in just a little bit lower probability conditions. So the person that is trying to trade every single day of December right there will go into the next year with more risk of error, with more emotional damage, with more emotions accumulated over that past month. So who do you think is going to keep their psychology in check? Me or the person that was trying to trade December whilst the conditions were just not that great? And that same goes for example, when you have NFP week. When you have NFP week, on NFP on Friday, you have Thursday and you have the Friday morning. So the London session ahead of that NFP. The person trying to trade that potential consolidation, that low probability conditions ahead of NFP on that Thursday and that Friday morning will have a lot of emotions accumulated before the actual high probability condition might even happen. So if we understand that, then what will I do? Well, I understand there's a person out there right now that's trying to trade NFP ahead of the actual news event, which is just low probability conditions in general. All right, perfect. So what do? I rest during that period. So I know once my time comes right there, once my time comes to actually get involved, I will keep my psychology in check longer. So my consistency over the long term is a lot better than someone who's boom every day, every night, every single minute of the day trying to get involved, trying to find a trade ID. No, I rest. I'm an eagle. I pick my time when to actually dive in and catch that rabbit who's not paying attention to the overall bigger picture. That is who we are, and that is our mindset here. And that is very important to understand, because when you see me sometimes take a step back in the market, it's not that I'm not interested in the market. It's just I know it's better right now to take a step back, and to then, when high probability conditions are there, I'm boom, 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 getting involved. 40 lots, my 4 trade accounts, perfect. 1 lot on those, 1 lot on that. All the accounts are getting activated. So when the time is there to jump in, I jump in fully. And that is again the mindset that we need to have. Where in the meantime, we just simply rest. That is extremely important. So again, the way I see that, and that analogy that I wanted to use as well, is that we can constantly run. But if we're constantly running when it doesn't matter, then it's very futile, right? What are we running for? It doesn't matter. The outcome is not there. So what do? We run when it actually matters. So if someone that has been sprinting a marathon without actually getting an outcome, and we just sit and we wait, and sometimes here and there we sprint again to train our legs and to get a little bit faster, and then we sit and we wait. And then a person comes by next to us who's running to the left of us, and we see them running completely exhausted, completely up in their own mind, thinking all negative things, where they're like, I've been running for so long with no outcomes, etc. And we just sit there on a chair, and we see him running by to the left of us, and we get up and we sprint the absolute shit out of ourselves, and we beat them. We beat them easily. Why? Because we understand the game. We understand there's now a time to run. So we beat you to the place. And that is exactly what we are here to do. So where the technical levels, again, the technical analysis, yes, we are outcompeting persons as well. We are outcompeting people on a technical analysis as well. But the technical analysis is in harmony with understanding the psychology. The psychology is where we are truly almost beating people. Almost, well, horrifyingly beating people, where people just don't pay attention, where we are just so much better than other people. And I say that in a very humble manner, but it's very true, where we overall as a collective group are just so much better than other people out there when it comes to trading. And that's the reality of things. So how do we get that risk of error down again? That is by that rest, where someone else is currently there, and it's even above it right there, where we could argue, all right, that person right now is on the edge. It's on the edge of messing up. It's on the edge of revenge trading, on over trading, where we are constantly trying to bring this down, shoots up, bring it down, shoots up again, bring it down, bring it down, bring it back to the beginning. And then after that, when we have a fresh mind, we can get involved again. And when we have that fresh mind, we know we will outcompete another person that is looking at the same thing as us. Even if it's a profitable trade, right? Doesn't matter. Because the person right there that took a few losses or took even a few winners, their risk of error is increased. So their perspective on that new trade ID, which we see as high probability, their perspective has changed on that trade ID. They see it through a manipulated lens right now, where it's just not objective. They don't see it as it is, where we see it as it is. They might see it as, oh, but I have this, I'm all kinds of thoughts through their mind, and they think, all right, this might be low probability. I'm seeing a fair value gap there, which could be high probability. This could also be low probability. Let me micromanage my trade ID right now. They are not in a fresh state of mind where we are. We are ready to attack, and they simply are not. So this is the psychology meter, and this is extremely important to understand, because once you get that experience in your technical analysis and the technical analysis becomes very smooth, then all you are going to be doing for the rest of your trading career is the psychology meter. That's truly it. And again, over time, of course, through experience, will you add on to the technical analysis? Yes, of course, because you will learn certain things and you will learn, but that again will be added to your experience, to your intuition part, not to your mechanical part of your trading plan. So the majority of your time is going to be spent by monitoring your psychology meter. And that is exactly our focus as well. So remember what I said in the beginning, we have to pay attention to high probability price action and all those small details. So it is likely more difficult. Well, likely it is just going to be more difficult, where I have already gone through that phase. I already have the experience. Me analyzing a pair is done very quickly. Me getting to the entry pattern is done very quickly. Don't need to think about it a lot of times, where I can just fully focus on my psychology meter, where your attention is divided in 50-50, where you have to focus your attention on psychology, but also on your trading right now because you're trying to learn that. Perfect. That's the time to lose. That's the time to lose. Absolutely perfect. And afterwards, we can slowly start winning once we are getting more used to it. Perfect. So moving on to the next video, where we're also going over certain aspects in our psychology. Perfect. Thank you.